Hi, I wanted to just go over a few Wyckoff terms and concepts that were raised in session one. There are several people in this subscribing to this video who are not that familiar with Wyckoff, so I thought it'd be useful to go over some of the common terms and concepts that we use and that I may have mentioned in the first session, so that you are clear on what these are. All right, so let's get to it. Shortening of the thrust. We certainly mentioned this. As the market moves either up or down, the length of its swings or thrusts begin to diminish. This is what we're looking for. We're always measuring the length of the swings or the thrusts, if you will, in a market movement. So if we're moving up, for example, and we have a move up that's 10 points long, and then we have a reaction, then we have another thrust up, but this time it's only 7 points. We have a reaction, and then we have another push up, another swing up, and this time it's only 3 points. Well, that's shortening of the thrusts, okay? And it indicates that the trend is tiring, and the trend can be going either up or it can be coming down. If we're coming down and we fall 9 points, we have a little rally, then we fall again. 6 points, we have a rally, and then we fall only 2 points. Well, that's diminishing thrusts down. It's shortening of the thrust to the downside. And it indicates that the trend is tiring and could very well be coming to an end in the very near future. Okay? So that's shortening of the thrust. Hypodermics. I mentioned this. Now, this only occurs in an uptrend, not in a downtrend. So at the end of an uptrend, or even sometimes we see it in lesser advances, a small rally, we'll see a swift and sudden drive up in price, but it's quickly retraced. Now, often it occurs in resistance, but it doesn't have to. It can be into new high ground. Either way, it's designed to attract late buyers and really weak buyers, people who have been sitting on the sidelines and suddenly see the market go up and they say, oh, I've been sitting here on the sideline, I've been missing all these profits, I've got to get in. It's designed to attract those kinds of buyers right at the top of the market. And then they get locked in because the market swiftly reacts. So Wyckoff, where does hypodermics come in to? Well, Wyckoff himself tried to give a little bit of a descriptive analogy, so to speak, and he likened hypodermics, or likened these moves, I should say, to a dying patient who's lying on the operating table, and the doctors are all standing around, wringing their hands, not sure what to do, and somebody has the bright idea to give the patient a shot of amphetamine, an injection of amphetamine. Amphetamine is a very strong stimulant, and that revives the patient. And, suddenly his vital signs look, he's got a strong heartbeat, and his pulse is good, and so on and so forth. But it's only temporary, because this patient, once the drug wears off, the patient reverts back to his original condition, and that's hypodermics. It's the same thing in the market. Once that stimulant, that swift drive up, has had its effect and brings the late buyers in, the market naturally reacts and retraces all of that hypodermic move up. And so that hypodermics is only temporary. The swift move up, the bullishness seen in the market is only temporary. All right, springs. This is a very common event in the markets. It's one of my bread and butter trades. I like it very much. So a market makes a swing low. It then rallies, and I like to see a good strong rally, maybe breaking any downtrend line that exists. And then we come back to the swing low. We don't hold a higher low, or just meet it and make what's commonly referred to as a double bottom, but the market actually goes underneath the low of that last swing, the initial swing low. But it doesn't stay there. It falls underneath. Maybe it goes under for a bar, maybe a couple, 3 bars, and then turns right around, doesn't go deep below, but penetrates only slightly, and then turns around and closes back up above that original swing low. This is a very bullish indication in the markets because it indicates that we brought the market back down and in effect kind of called out the sellers, said, come on and show us your hand, by bringing the market down below the last low, the last swing low. But sellers don't come out. And so buyers see this, they step in and strongly push the market back up, closing it back up above the last swing low. That's known as a spring. The upthrust is basically the opposite of a spring. We've been moving up, the market's been advancing and makes a swing high, then it reacts, and I like to see a strong reaction, kind of a sign of strength, a sign of weakness, if you will. We're going to talk about that in a moment, on that reaction, but then returns back up to the swing high and trades over it, but just briefly, a bar, 2 bars, 3 bars maybe, and it's unable to continue higher. Instead, it falls back down through and closes underneath that original swing low. So it's a mirror of the spring, and the upthrust is a bearish indication. In both instances, spring and upthrust, what the key idea here is failure to follow through. In the case of a spring, we are driving back down again or pushing back down again below the low, below the last low, and the market can't continue to go down. There's no follow through to the downside. In the case of an upthrust, the market rises above the last swing high, but fails to follow through to the upside. Sometimes these are referred to in the technical literature as false breakouts. And you can think about them that way. We don't look at them as false breakouts because that takes the idea of supply and demand right out of the definition. What we're looking for is a failure to follow through, indicating that in the case of a spring, selling is not able to drive the market down. Therefore, it's gone from the market at that point, and buyers are stepping in. And then in the case of an upthrust, buyers are no longer present in the market and sellers are stepping in. Okay? We always want to be looking at supply and demand, not just the big problem with traders in general. And in my judgment, one of the main reasons why so many traders are not successful is they take these concepts of breakouts and they're not thinking about what's happening in the market. They're just looking at that one indication. Well, the market breaks out or fails to break out and then comes back underneath. We're looking at it in terms of supply and demand. That's what moves the markets. Nothing else moves the markets. Even news reports are going to be driven. There's an underlying factor of either supply or demand that is supporting that news event, and so we always relate back to supply and demand, and that's important, and that's how we define springs and upthrusts in the terms of supply and demand. Okay, halfway point. Excuse me. It's the halfway between we refer to this a lot in point and figure charting. The halfway mark between the high and the low of a significant swing. Okay, so the market can retrace up to halfway back from its higher low, and the trend remains intact. That's an important concept. More than this, and it suggests that the trend is weakening. Less suggests the trend is strong. Okay, so for example, let's say we have a strong move up, and then we start pulling back. Well, we mark the halfway point between the high and the low, and we see what the market does. If it comes back to the halfway point, fine. As long as it stays and doesn't go much under that, the strength of that move remains intact, and we would expect continuation or follow through to the upside. If we come deeper than halfway back, then that indicates that that is not so strong, that move is not so strong, and that the market may actually be weaker. And so we start looking for signs of weakness. If it comes less than halfway back, it suggests the trend is strong, and we would expect to see a good drive out from that level. So if you think about the halfway points, what we're really measuring is the opposite of what's occurring in the market. If we have a strong move up, then we have demand coming in, right? The halfway point tells us if supply is getting stronger or not. If we go above or to the halfway point on the point and figure chart, it suggests that selling or supply is not that powerful, and so we would expect demand to resume. If it goes deeper than halfway, well, demand may not be as strong, and so we have to check our idea that demand is in control of the market. So frequently a measure in point and figure charting, and although I've talked about up moves here, it's the same thing with a down move. The market can move down, and then it has the right, so to speak, to rally back up halfway between the last high and low. And as long as it doesn't go much beyond that halfway point, that down move should be intact, and we would expect supply to resume its course and push the market down for a lower low. And as I say, it's a frequent measurement in point and figure charting, and it's a great way to just monitor the markets. How are they moving deeper than the halfway point, above it, right to it, and that gives us just another indication about the supply and demand equation or picture in the market. Okay? All right, tests. We talked about this in the session. Tests are a little bit different perhaps than you've heard before. Maybe not, but I want to go through them. After a market holds support, we will frequently see the market rally up a bit. Not making a new high necessarily, but rally just the same. And then return to support, either coming all the way back down to it, or frequently we see it hold a higher low not far from support. And that's sort of the picture that we see. And the concept behind it is that the market is testing for supply. And if it doesn't find any supply or selling down there, the market will turn back up and rally higher, usually pretty aggressively. Okay, so let's go through this a little bit more detail. So for example, the market comes down, makes a swing low, and then we see a rally. We'd like to see that rally be pretty robust and strong. And then we'd like to see the market pull back. And on that pullback, we expect to see a weak pullback if we're looking for a test. Okay, and that test will look like on a vertical line chart, the price bar and volume chart. It will have smaller ranges, the difference between the high and the low. Smaller ranges on the pullback than the ranges that we saw on the drive up. And volume should start to recede, particularly as we get down, as we go down in that reaction, in that pullback. So smaller price bars, smaller volume. And it can go all the way back to the support, or more frequently it will hold at a higher level than support. And because we see the support holding there, that low holding there, higher low or support, and not follow, again, we have this idea of following through to the downside. It's as if we are disconfirming the presence of supply or selling by seeing the market pull back, almost as if it's encouraging the sellers to come out, saying, okay, now we're coming down. So if there are sellers in the market, we would expect them to start jumping on board and driving the market down lower if the market really is laden with sellers, if the sellers are still dominant in the market. When we don't see that, and we see the light volume and the narrow spreads, or only one or two figures on the point and figure chart, and then the market starts to push back up, we know that that's a test. And often this is a good spot for a trade to be initiated because it indicates not only that support is strong, but it's also and held, but it's also been tested as well, disconfirming the presence of supply. Often support will bounce off of support only to come back down through support. I'm sure that's happened to everyone listening to this video. And the test is a way to help us prevent that, okay? Now, tests don't just occur at support, they also occur at resistance. Again, it's kind of a mirror of the testing at support. Sometimes we might refer to this, like for example, Tom Williams will call this a no demand. But Wyckoff would have called it a test. They're equivalent. So the market holds resistance. In other words, the market comes up to resistance, finds supply coming in, right? And then reacts. And we'd like to see that reaction be pretty strong. Then we have a weak rally back up, and it either goes a little below the resistance, which is actually an indication of greater weakness, or sometimes it goes right up to the resistance level. But again, we'll see on a vertical line chart, narrow spreads, light volume. On the point and figure, it'll be one or two figures that occur. And again, just like with support and testing of demand, of supply, selling, now we're testing demand, okay? So it comes up to or a little underneath resistance, checking for demand, disconfirming the presence of demand, because as we all know, when the market starts to rally up again, oftentimes we'll see buyers come in and start to see it get marked up. But if they don't come in, then we see it as a test. And again, just as with support, this is often a good spot to initiate a short trade. Now, both springs and upthrusts are also frequently tested. Think about this. On a spring, if the price goes below support, doesn't find sellers, rallies up a little bit, then comes back down and tests that once more, it's like a double confirmation of no supply. That's a very strong indication and often a good buy point. Now, that doesn't always happen, I have to say. Frequently we'll see tests, but just as frequently, I think, and maybe even more so, the market will rocket off of a spring and drive straight up. Often that has to do with the volatility. If the volatility is expanded in the market, then frequently we don't see springs tested. And same thing with upthrusts. Upthrusts are frequently tested as well. We'll see the market make a new high. We go up above that for a bar, 2 or 3. Then we come back down. And then we have a weak rally up, not going all the way back up to the top of the upthrust, but either to the resistance, the original resistance level, or just underneath of it. And that's often a great spot for a solid spot to initiate a short trade. High odds at that point, again, because sort of a double test of failing to follow through and then testing for demand. Okay, demand and supply lines. These are the areas or the lines in a trend where buying, otherwise known as demand, or selling, otherwise known as supply, has come into the market. Okay, in trends where we can establish a trend channel, the upper trend line is referred to as a supply line and the lower is referred to as the demand line. Sometimes we, in the Wyckoff literature, will see it as described as a support line. So let's say we are in an uptrend and we make a higher high and then a higher low and then another higher high, and we come back and we're looking for the market to hold at the trend line, at the lower trend line. This is called more descriptively the demand line. We expect demand to come in at that point. Same thing in the supply line. Even in an uptrend, we are, well, let's do the downtrend first. In a downtrend, we make a low, then a higher low, a lower high, excuse me. We make a low, then a lower high, and a low, and now we've established a downtrend. We've established our supply line, our trend line, trend channel. So we expect supply to come in at that trend channel line. Well, we just called it the supply line to be a little bit more descriptive. Now, in an uptrend, we also have demand and supply lines. The demand line is pretty obvious, but as the market moves up, makes a high, supply comes in at that point, right? And then we have a reaction, a little pullback, demand comes in, we rally up to a new high, and often that's right at the upper trend line in a trend channel. Well, that's our supply line there too. We expect supply to enter the market because the market is getting overbought in the trend channel at that point. Okay? So that's demand and supply lines. Fairly straightforward. Danger point. What are we looking at here? This is the price area or level that tells us that our trade is on the wrong side of the market. And if the trade is going against us, we exit with a minimal loss. Okay. So for example, let's say we're selling the supply line in a downtrend. So we're selling near the danger point. The supply line becomes our danger point, okay? If the market turns around and rallies and closes above the supply line, well, we know the trade is in trouble. So we know the trade is wrong. So we exit there and we take only a minimal loss, all right? When we take trades at or near the danger point, which is generally where we want to initiate trades, it's the risk is going to be low, so it's always the preferred entry location. If we're taking a breakout trade, for example, we're not really buying or selling near the danger point. It's pretty far away, so we have to place our stop at the halfway point between the low and the high of that swing as we take the trade near the high of that swing if we're taking a long trade. So we have to place our stop halfway down. That's going to be larger usually than a stop placed right near the danger point. So for example, if we're in a trading range and we have horizontal supply and demand lines, we might take a trade at support and we have our stop right down below support, and we know that if the market turns on us and closes below support, the trade's in trouble, so we exit, but we get a chance to exit near the danger point where the risk is low. So that's the idea of the danger point. Basically, there's two concepts. That's where we want to try to initiate trades, and that's where our risk is going to be the smallest in general. Okay? Signs of strength and signs of weakness. SOS, SOW. When the market's been in a trading range or in a downtrend, for example, and then we see it rally strongly, and we're going to see on the vertical line chart the wide price spread, wide spread in the price bars or the ranges, closing near its highs and with increasing volume on the rally, then we note this as a sign of strength, and we expect demand to continue to drive the market higher. And the sign of weakness is just the reverse of a sign of strength. When we're in an uptrend and we see the market move on the point and figure chart, we see the market move in a straight line up. That's a sign of strength, right? And then we expect that demand to continue, which will be confirmed by what? A move down to or above the halfway point, and kind of a choppy move, not a straight down move, but one that shows a little more, if we were looking at a vertical line chart, a lot of price bar overlap rather than a swift move down. Okay, and then the reverse is the case for a sign of weakness. The market falls in a straight line down on a point and figure chart. We would view that most likely as a potential sign of weakness, and then we want confirmation on the next rally or pullback. Okay, so that's signs of strength and signs of weakness. Wyckoff story. This is probably the most important concept in the Wyckoff, in the modern use of the Wyckoff method. Interestingly, if you look through Wyckoff's materials, you can see it there, but it never was explicit. He never says this is the story of the market, or this is the Wyckoff story. But it was later developed by David Weiss, who is a great Wyckoff trader. And so I borrowed the concept from David, who is my mentor still, and I'm still a student of his, although not formally these days. But we're good friends, and have a lot of respect for David. He taught me the Wyckoff method, so I would encourage you to look at his materials too, particularly his book on his most recent book called Trades About to Happen. Okay, so trades with the best odds of working out. If we're taking a long trade, the ones that are going to produce, see the market continue in the direction to the upside. Or if we're taking a short trade, those trades that we see the market continue to move to the downside. The trades with the best odds are not those that have only a single indication, such as an action on an indicator. And here's where I believe traders have great difficulty. They read in a trading book that's if the indicator does this and if price action does that, then we want to take this trade, right? Well, that's a very simplistic way to look at the market from the way that we look at the market. We don't do it that way. We're not basing our trading actions or our ability to read the charts on one or two indications. We are keenly interested in supply and demand. And as you will see if you get into this method, if you study this method, markets rarely turn without signaling what they're going to do. Occasionally that happens. There's nothing that's 100%, but most of the time, V-spike reversals is a market that turns on a dime, so to speak, right? That occurs maybe 10 to 15% of the time in the market. So why focus on that? Focus on the 85 to 90% of the times that the market turns. And when it does that, it's going to show us multiple indications that changes in the supply and demand are occurring. And it's these multiple indications that form the basis of a Wyckoff story. We don't just take things on one indication. We're looking at multiple indications, several indications that supply and demand is changing. And it's these multiple indications, or the Wyckoff story, that creates the opportunity for a high odds trade. So, for example, a market may be trending down, and we start to see shortening of the down thrust, right? Maybe we've moved from 10 points, then the next swing down or thrust down is 7 points, and now we see another thrust down is only 3 points. Okay, so we have shortening of the thrust. Then we see a rally come, and that breaks the downtrend line. We have a strong rally now that occurs. Okay, there's a second indication. So we have shortening of the down thrust and a strong rally. And then the pullback off of that rally is fairly choppy and weak, and it tests the last swing low on lighter volume if we're looking at the vertical line chart, and maybe it's holding a higher low. Well, those are additional indications that selling has dried up in the market and buying is starting to take control. Okay. Now, we'd also be looking at the point and figure chart to make sure that the last down count has been satisfied. We went through that extensively in the first session. And also whether there's a sufficient count to make the upside worthwhile. Remember, the point and figure charts serve as a way to protect us from ourselves sometimes. We want to jump into the market, and we don't want to do that if there's not a good count. If we're using point and figure charts to make our getting into the market worthwhile. So if those conditions are met, then we may enter a trade in that case. So the Wyckoff story is all about reading supply and demand, and it's all about seeing numerous things, several things occurring that indicate that supply is drying up and demand is starting to take control, or that the buying is losing its impact. We're seeing less and less demand to the upside, and supply is getting stronger, and we're just looking for an opportunity now. If we have a decent count to the downside, we're looking for an opportunity to go short. Okay, so that's the terms. I'm pretty sure that covers all of the terms that I've gone over in session 1. If not, I will add to this, and if I bring up other terms in session 2, which may happen, we will add to this. We'll make an amended video for this. But this should get you started, particularly for those folks who are not familiar with the Wyckoff method. And even for those folks who are familiar, maybe you were a little fuzzy or a little cloudy on a given term or two, and hopefully this will help set you straight. Okay, that's good. Thank you.